The year is 1933. 25% of Americans are unemployed. Banks have collapsed. Entire life savings have vanished overnight. Families are hungry. And yet, almost no one has credit card debt. Almost no one has a car payment. Almost no one owes money to a bank they've never walked into. How is that possible? Today, in the most prosperous era in human history, the average American carries over $100,000 in total debt. We have more than they ever dreamed of, and somehow we owe more than they could ever imagine. These are 10 money habits from 1933 that we have completely abandoned, and abandoning them is costing us everything. 1. The envelope system. Before banks were trusted, and in 1933 they weren't trusted at all, families managed every dollar in cash. Physically, in envelopes. Each envelope had a label: rent, food, coal, medicine, shoes. When the envelope was empty, the spending was over. There was no overdraft. There was no, "I'll figure it out next month." The envelope was the budget, the bank, and the financial advisor, all in one. Today, we manage money through a screen. We swipe without seeing. We subscribe without remembering. We spend money we don't physically have on things we can't physically hold. The envelope system still works. Financial advisors charge $300 an hour to teach it. In 1933, every broke family already knew it. 2. They didn't buy it until they had the money. This sounds obvious. It is not how we live. In 1933, if you wanted a new coat, you saved for the coat. If saving took 3 months, you wore the old coat for 3 more months. If the old coat fell apart, you mended it. Buying something you couldn't pay for in cash wasn't just uncommon. It was considered shameful. A sign of poor character, of living beyond your means. The Great Depression didn't create this mindset. It confirmed it. People who had borrowed to invest in the stock market lost everything in 1929. People who had lived within their means, quietly, without flash, had something left. We have reversed this entirely. Today, buying on credit is normalized. Carrying debt is expected. Living paycheck to paycheck is considered just the way things are. It is not the way things have to be. It is a choice we make every single time we swipe a card for something we cannot afford. 3. The barter economy. Was real and massive cash was scarce. Skills were not. In 1933, entire communities operated on informal barter networks that would astonish us today. The doctor took eggs as payment. The farmer got his fence fixed in exchange for vegetables. The seamstress traded alterations for firewood. This wasn't poverty. It was intelligence. It was a recognition that money is just a representation of value, and that value can be exchanged directly without the middleman. Today, we have forgotten that our skills are currency. We feel financially trapped and never think to ask, what can I do that someone else needs? A plumber who teaches a neighbor basic repairs in exchange for bookkeeping isn't doing something strange. He's doing something ancient, practical, and completely outside the debt economy. Your skills are worth more than you think. In 1933, people staked their survival on that fact. 4. They had no subscriptions, none, no Netflix, no Spotify, no gym membership, no cloud storage, no meal kit delivery, no streaming bundle, no software subscription, no phone plan, no insurance for the insurance. In 1933, every dollar spent was spent once, on something real. A loaf of bread, a pound of coal, a pair of soles for a shoe. Today, the average American spends over $200 a month on subscriptions and underestimates that number by half when asked. We pay for things we forgot we signed up for. We pay for things we used once in January and never canceled. We pay recurring fees in our sleep. The subscription economy is built on one psychological insight. Small amounts feel painless. $9.99 here, $14.99 there, until you add it up and realize you are paying rent to 12 different corporations for things you don't need. A family in 1933 would have considered this insane. They would be right. 5. The Community Savings Club, the Tanda. When banks failed and credit disappeared, communities invented their own banking systems. Groups of neighbors, co-workers, or church members would pool small amounts of money every week. Each week, one member received the entire pool. Then the cycle continued until everyone had received their sum. No interest, no fees, no credit check, no banker getting rich in the middle. This system, known as Tanda, Susu, Hui, or rotating credit association, depending on the culture, is thousands of years old. It survived the Great Depression because it was built on something more reliable than any financial institution: community trust. Today, this system still exists in immigrant communities across America. It is statistically associated with higher rates of homeownership and lower rates of debt among the communities that practice it. The bank does not want you to know your neighbors well enough to trust them with your money. The bank wants to be the middleman. In 1933, people cut out the middleman and survived. 6. They repaired everything, including money mistakes. In the Depression, if you made a financial mistake, a bad investment, a failed crop, a business that didn't work, you didn't declare bankruptcy and start over with a clean credit score. There was no clean credit score. There was only your reputation. Your reputation in the community was your credit. If you owed someone money and couldn't pay, you worked it off. You showed up. You made it right, slowly, over time. Because the person you owed money to was also your neighbor, your customer, your child's teacher. This accountability system was brutal. It was also clarifying. You thought very carefully before making a financial commitment, because breaking it had real social consequences you couldn't escape. Today, financial mistakes are abstracted. They become numbers on a report, points on a score. We have built systems that allow us to fail without consequence, and then we wonder why we keep making the same mistakes. 7. They grew. Part of their own food. This is a financial fact, not a lifestyle choice. In 1933, even urban families kept small gardens, window boxes, backyard plots, a few chickens if zoning allowed. Not because it was trendy or virtuous, because every tomato you grew was a tomato you didn't have to buy. The Victory Garden movement of the early 1940s grew directly from Depression-era habits. At its peak, 20 million American households were growing food. They were producing 40% of the country's vegetables. Today, the average American family spends over $1,000 a month on food. A small garden, even container herbs on a windowsill, can offset $50 to $100 a month. Over a year, that's a car payment. Over 10 years, it's a down payment. They didn't call it financial strategy. They called it not starving. The math is the same. 8. They read the contract. In 1933, if you were one of the rare people who signed any kind of financial contract, a mortgage, a lease, a supplier agreement, you read every word, or you found someone who could read it to you and explain it, because the consequences of not understanding what you signed were immediate and physical. You lost your house, you lost your farm, you lost the business that fed your children. Today, we click, "I agree," on contracts thousands of words long without reading a sentence. We sign mortgage documents we don't understand. We accept credit card terms we've never looked at. We agree to auto-renewal clauses we don't notice until we're charged for a year we didn't want. The fine print has gotten longer. Our patience for it has gotten shorter. And the financial industry has built an entire profit model around that gap. In 1933, not reading a contract wasn't an option. Today, it's a habit, and it's an expensive one. 9. They saved before they spent. The modern financial advice is to pay yourself first. Set aside savings before spending on anything else. Every personal finance book published in the last 50 years contains this advice. In 1933, this wasn't advice. It was survival. Before any dollar was spent on anything discretionary, a portion was set aside. In a tin, under the mattress, in a coffee can buried in the backyard. Banks had failed. Mattresses didn't. This habit, saving a fixed amount before any spending decision is made, is the single most consistent predictor of financial stability across every income level. It works whether you earn $30,000 or $300,000 a year. We know this. We just don't do it. We spend first and hope something is left at the end of the month. Usually there isn't. The people of 1933 saved first because they had seen what happened when you didn't. We haven't seen it yet. We may be about to. 10. They knew exactly what everything cost. Ask the average person today what they paid for their last grocery run. Most can't tell you. Ask what their monthly utility bills total. Most have to check. Ask what they're paying in interest across all their accounts. Almost no one knows. In 1933, a housewife managing a family budget knew the price of flour to the cent. She knew how many loaves she could bake from a 5-pound bag. She knew exactly when the coal would run out and how many weeks until she could buy more. She tracked everything because everything mattered. Financial awareness isn't complicated. It's paying attention. It's knowing the numbers. It's understanding the exact relationship between what comes in and what goes out. We have built tools that are supposed to make this easier. Apps, dashboards, automatic alerts, and yet we are more financially unaware than any generation before us. They were poor, and they knew every number. We are wealthy, and we know none of them. That is not a coincidence. That is a system working exactly as designed. The people of 1933 didn't have financial literacy classes. They didn't have YouTube channels or personal finance influencers. They had consequences. Every bad decision had an immediate, physical, visible result. So they made fewer bad decisions. Not because they were smarter, because they couldn't afford not to be careful. We can afford to be careless, until suddenly we can't. The wisdom of 1933 isn't about going backwards. It's about paying attention before we're forced to. If this changed the way you think about money, subscribe. Next week, we go deeper.